Hello and welcome to the forum. Every week, we take no more than 15 minutes to discuss the 3 highest conviction ideas surfaced across the Smartkarma network, cutting through the noise and helping you zero in on what truly matters most. The live forum and Q&A session are exclusively available to Smartkarma Plus subscribers. You can always revisit previous episodes on this YouTube channel. Without further ado, let's dive into this week's ideas.
Very good evening, ladies and gentlemen, and welcome to the Smartkarma Weekly Forum. The forum is meant to be a high-impact weekly live webinar that's exclusive for Smartkarma Plus subscribers. We use this to discuss some of the best, highest conviction insights surfaced across the Smartkarma network. A reminder of our disclaimer: the forum is meant purely for informational purposes and does not constitute investment advice. It is the opinion not of Smartkarma, but that of our insight providers. And lastly, Chatham House rule applies. Every week, we bring 3 key ideas to you. These are roughly organized into a small and mid-cap idea, a large cap, and a thematic. At the end of every week, we make video recordings of the forum and upload them to our YouTube channel. We do this so that in case you could not attend the forum in person and wanted to revisit it, you can now do it at your own time. You're also free to share recordings of the forum with your friends with whom you might be discussing your investment ideas. This week, we will kick off with a large cap, one of the largest caps perhaps within the China tech universe, which is Alibaba. And we will once again revisit what the fair value of Alibaba looks like. And we will cut through some of the noise that has been there in the market right now and look at this on very, very simple terms. Second, we will look at 2 mid-caps, which is Vinda and Hengan. These are both consumer staple companies, and we look at how they might be positioned for this time in the market. And lastly, we will explore some ideas in the FX space and perhaps also introduce some of our top FX writers for you who are on the Smartkarma network. So let's kick things off. Alibaba Group. As you guys are aware, Alibaba has a dual listing. It is listed in the US under the ticker BABA space US. It is also listed in Hong Kong under the ticker 9988 Hong Kong. This is just under $300 billion of market cap. And as the chart on the right-hand side shows you, the stock price has not done very well over the last 1 year. And there are a few key analysts who cover Alibaba on the Smartkarma platform. Today, we will be looking closely at an insight from William Milan. William is a global emerging markets analyst who focuses on the information technology sector. He was also on the buy side previously. And we feel that William has a great ability to present complex arguments in a very, very simple way. Okay, just sort of quickly, what does Alibaba do? Well, Alibaba is a very, very large company today. It started off as an e-commerce platform. It has expanded into internet infrastructure because of its cloud computing business. It also expanded into financial services through Ant Group, and it also provides other types of internet content services today. One of the most impressive things about Alibaba is that despite the very large active user base, it has still continued to grow this user base by over 10% year on year since 2019. Thirdly, Alibaba has successfully expanded its presence into rural China. It has done that through Taobao deals and also Taocaicai, which is a community marketplace business. Why is this important? This is important because this secures future growth for Alibaba. Now, troubles for Baba started almost 2 years ago now when the IPO of Ant Financial, which is its financial services arm, was pulled out of the market at the nth hour. If we look at recent market chatter, it appears that the IPO might be back very soon. Its dual listing plans clearly seem to have Beijing's blessings. So this is quite an important turn in regulation that we are paying attention to. Now I will refer to the table on the right-hand side, and this is important. This is a very, very simple sum of the parts valuation for Alibaba. And as William has done that, he has brought about a very interesting point, which I'll share with you. So if you look at Alibaba's current market value at roughly 100 Hong Kong dollars a share, you will notice that nearly $19 out of that 100 comes from net cash, which is great. He has booked very, very small values for its listed associates, as well as for the unlisted investments that Baba has made, just only about $7 a share. Okay, so what happens is, so the rest of the business, the implied value comes at about $71 a share, out of which, if you remove a bunch of the other stuff, you're left with about 72. So if you work backwards, you will realize that the core e-commerce business of Baba is being valued at only 6 times EBITDA, which is an enormous discount even to companies like JD and Tencent. So it really is extremely cheap. And in doing this analysis, actually, William has given no value, zero, literally, to Ant Group. Now, we know for a fact that if Ant is allowed to IPO, and we think the chances are growing, this number is no longer going to be zero, and it will be an important catalyst for Baba. Meanwhile, if you look at this core e-commerce business, which is being valued at only 6.8 times EV to EBITDA, and look at its growth, this is the revenue number. Revenue, it has been growing by 44% in 2021, and it's still expected to grow at a very healthy 15 to 70% clip for the next 2 years. When you look at profitability, again, this has been going very, very fast, and people are now expecting this to even decline. So that tells you that expectations are very low in the market, valuations are very cheap, and there might be catalysts on the table very soon for Baba. So when you cut through the noise, Baba looks very interesting at this juncture. For some of the institutional investors, they might even play this against some of the more expensive names. And the risks to Baba here are, prolonged regulatory action, sort of a permanent withdrawal of that IPO and no plans to crystallize value, and a further decline in profitability. But as it looks, none of those risks seem to be manifesting themselves. Let's move on to the next question, the next one. By the way, you can ask questions at any point of time using the Q&A button on your Zoom application. You're also free to post your questions as discussions on the Smartkarma platform. Let's move on to Vinda and Hengan. So the ticker for Vinda is 3331 Hong Kong, and Hengan is 1044 Hong Kong. Again, both of these charts show a declining trajectory of share price performance. Again, if you look at the market caps, Vinda is about $2.6 billion. Hengan is about $5.5 billion. Okay, so what do these companies do? Well, both companies manufacture personal hygiene products. Think of this as toilet paper, diapers, sanitary napkins, that sort of stuff. They sell these products under very well-recognized brands. Vinda has superior margins on the tissue side, but Hengan's sanitary napkin business has better margins. Vinda has actually grown its profitability much better than Hengan over the last 2 years. They are cheap versus peers, trading at between 31 and 34% discount. They're also benefiting from increasing affluence, product quality awareness, and there is certainly upside when pegged to long-term valuations. But why are we profiling these two companies today? Well, one of the key reasons for the decline in share price over the last 2 years has been people's concerns about increasing raw material costs, especially paper and pulp costs. Now, we know that commodities have been very, very strong. Most of these prices are extremely elevated at the moment. However, if the global economy starts to go into recession, we will notice some of this exuberance in commodities take a breather. And when that happens, Vinda and Hengan will start to outperform very, very nicely because demand for personal hygiene products is very resilient, even in a recessionary environment, and their margins will see enormous expansion. Another thing to note is these companies have very good pricing power. They're market leaders and they run very well recognized brands, as I mentioned. So once, in this high inflationary environment, these companies will also be looking to raise pricing, whereas their smaller competitors do not have the same pricing power. So you get this double benefit to these companies. Input costs fall and pricing power kicks in at about the same time. So it looks like a very interesting part of the cycle for us to be exploring Vinda and Hengan more closely. Of course, this is a contrarian idea at the moment. Their margins and profitability will still be depressed because of those high raw material costs, but we're looking at the cyclical turning point for these names now. And with that, I will proceed to the third and final idea, which is emerging market currencies. This is sort of in the thematic or FX bucket for us. The reason we wanted to feature this is just to highlight that Smartkarma is a platform not just for equities, but also for currencies and credit. On the currency side, we have very impressive analysts like Gautam Jain on the platform. Gautam has been a fund manager for the last, better part of 2 decades. He's worked at some of the largest macro trading shops, and we're very, very pleased that he's on the platform writing on emerging market FX. So as we all know, within emerging market currencies, there has been just one sustained trend, which is the strength of the US dollar. It has appreciated by about 7.3% since Russia's invasion of Ukraine, roughly about 120 days ago. It has led to a broad risk of environment insofar as emerging market currencies are concerned. In aggregate, these currencies have depreciated close to 5%. But if we look very closely at which currencies have suffered the most, actually the Hungarian forint is the worst performer. It is not just about the economy of Hungary, but it's also about politics, which has led to this decline. Within Asia, we've seen underperformance from the Chinese yuan and the Taiwanese dollar, followed by the Indian rupee. The way Gautam looks at these currencies, there is an element of mean reversion and improving fundamentals that he looks at from a sort of shorter term trading perspective, but then he also provides some longer term ideas. So on a shorter term perspective, the Taiwanese dollar, the yuan, the ringgit, as well as the Korean won are the ones that you would want to buy if the US dollar starts to weaken from here. Those are the ones that would have the highest beta on the upside. So with that, I will pause now. If you have any last final questions, now's the opportunity to ask. Otherwise, kindly post them on the platform and we'll have analysts respond to you directly. Great. Since there are no questions, I'll wrap up the forum for today and we look forward to speaking to you in a couple of weeks' time. Thank you very much. Bye-bye.
That's it for this week. You can find more ideas like the ones we discussed today on demand on our YouTube channel. Remember to subscribe and hit the notification button. If you like these ideas, spread the word. Tell a fellow investor about Smartkarma Plus and follow us on social media. Just search for Smartkarma. And of course, don't forget to visit smartkarma.com for more independent, differentiated investment insights. Thanks for watching and see you next week.